What's up, everybody? My name is Shaq, and I'm the host of the Assets Corner. Today, we will be talking about the three major players in the investment game: ETF, mutual funds, and individual stocks. And there is a bonus in the end where I explain you how you can start investing today and achieve your financial freedom. So keep watching and see you there. ETF or exchange trade funds are baskets of securities that are traded on an exchange just like another stock. They are designed to track an index or a sector like the S&P 500 or tech stocks. ETF offer diversification on low cost, making them a popular choice for investors of all levels. For example, in this chart, you can see that the Vanguard S&P 500, which is an ETF that tries to match the S&P 500 index, is pretty similar to the index. And why is this important? Because the annual return of the S&P 500 for the last 10 years is 12.3% by the time I'm shooting this video in February 2023. Meaning, if you had invested $10,000 10 years ago and you had contributed with $300 every month, you will have around $99,500 right now. So, although you will have invested $36,000 in total, the interest will have been $53,500. The next one are the mutual funds. Mutual funds are similar to ETF in that they also offer diversification by pooling money from multiple investors to buy a variety of assets. However, they are not trained on an exchange like ETF or individual stocks. Instead, they are bought and sold at the end of each trading day based on their net asset value or NAV. Mutual funds can be actively managed or passive managed with fees and expenses depending on what you take. Actively managed mutual funds are run by professionals who pick and choose which stocks or investments to buy and sell in order to try to beat the stock market and make investors more money. However, because these funds involve a lot of research and work, they usually have higher fees and can be a lot riskier. A passively managed mutual fund, on the other hand, simply tries to match the performance of a particular stock market index, like the S&P 500 or the Dow Jones Industrial Average. This means that the funds buys all the stocks in that index and just hold on them rather than trying to buy and sell based on the market trends. Because these funds involve less work and research, they typically have lower fees and are less risky, but they also have less potential for huge gains. So now you might be a little bit puzzled on what's the difference between ETF and passively managed mutual funds. In a nutshell, passively managed mutual funds and ETF, they both track an index, but they have difference in the fees as well as the minimum investment. So not just ETF, they are much cheaper, but if you go, for example, to a fractional broker like the one in the description below, you could buy an ETF for as low as $0.1. If you want to know more about the difference between ETF and passively managed mutual funds, let me comment below. So finally, we just have the individual stocks. Individual stocks are shares of ownership in a single company like Amazon, Apple, Google, which is by the way called Alphabet, and they can be bought and sold on the stock market. Stocks offer the potential for high returns, but they also come with higher risk and require more research and analysis than ETF and mutual funds. You have to think that if you have 30 stocks, you have to watch them all and follow them all, while with ETF and mutual funds, you just buy once and that's it. However, if you want to go for stocks, you should aim for at least 15 stocks and you should try to have between 25 and 30 stocks in the future. Otherwise, you will be exposed to the market because you are diversified. I'm thinking about putting a video up there which goes a little bit deeper in portfolio diversification. So don't forget to subscribe, hit the like button and the notification button so that you can stay up to date. But wait a moment, we are not finished for today. There is still the question, where should you invest today and how to achieve your financial freedom? So let's go into it. In terms of historical returns of these three investment options, the average annual return for ETF over the past 10 years is around 10%. Mutual funds have averaged around 8%, and the S&P 500, which is often used as the benchmark for individual stocks, have returned an average of around 13% over the same period, as we actually saw in the beginning. But wait a moment, everyone who wants to invest in stocks, they try to beat the S&P 500, which generates 13% in average. So what if you invest in an S&P 500 ETF? And yeah, man, that's why probably the best investor of our time has said many times, consistently buy an S&P 500 low-cost index fund. I think it is the thing that makes the most sense practically all the time. Or I think buying the S&P 500 index funds is probably the best thing to do. And that's actually the thing, as we saw in this example. So let's think about it for a moment. If you invest in the S&P 500, you don't have to worry about it that much. You don't have to do much research, and you probably will have a better return than most of the people who invest. So as an strategy, what you could do is you could put, I don't know, $100, $300 or euros, depends on where you are, put it aside every month, then invest it in the S&P 500 ETF, and then after 30 years having around 13, 15, 12% return, how much you will have? You have a lot of money, and then you could achieve your financial freedom. So you might think, okay, if that's so easy, why people don't do that? Because people is greedy and everyone thinks that everyone is the difference and everyone tries to beat the market. Plus, investing in the S&P 500 is pretty boring, man. You don't have anything to do, there is nothing to research, there is nothing that you have to read. You just put your money there every month and that's it. So as soon as you start investing, you get like this kind of fever and then you try to do weird stuff and there the problem comes. So if you just put the money in the S&P 500, that's it. But if you think that you can beat the market, try to watch the next video where I will explain if it is actually possible to beat the market. And spoiler, it is. Some people has done that before, but you have to stick to a plan. So thanks for watching. If you enjoyed the video, don't forget to hit the like button and subscribe for the next video. And if you want to check an even more basic video about investment, check this video here that I put there last week. And as I always say, never give up and try to be the best version of yourself. Check out.